class. In this video, we're going to look at doing a payroll transaction. This is something that you're going to have to do in your practice set. So I've created an example, and this looks a whole lot like your practice set. I actually just took it from the practice set and changed the numbers a little bit. So we've got a company that has 2 employees. Employees receive a monthly salary, and that's $1,800 each. It says payroll is processed on the 27th of the month, and then they actually get their paychecks on the last day of each month. And then we've got some tax rates we need to consider. So when you're doing recording payroll entries, there are actually 2, and then we'll talk about the third entry that we need to do. So the first 2 entries we need to do is, the first thing we need to do is to record the expense for payroll that the company has incurred just by employing those individuals. The second thing we need to do is to record the payroll taxes that the company is actually paying. And then in a few days, we're going to pay those checks. So we're going to record that as the third entry. So we're going to get started. And let's just make this 1127. All right, so when a company records the expenses for payroll, the easiest way that I can explain that journal entry is to think about your own personal payroll check stub. So if you have a job and you get a paycheck and you look at your paycheck stub, you're going to see a lot of information on there. And the first thing you're likely to see is your gross pay. And so that's the total amount that you actually earned by doing work. Unfortunately, you don't get all of that. There are taxes that have to be paid. So you'll see your gross pay, and then you'll see all those taxes that are withheld from that gross pay, and then the bottom line is the net pay, which is actually your take-home pay. So this journal entry looks a lot like that. The pattern is pretty much the same. So we're going to start with salaries expense. And that is the gross pay, just like it is on your paycheck stub. The expense to the company is actually the total amount that you earned. Even though you might not get a check for that total amount, the company has incurred an expense for your gross pay. So in this example, we have 2 employees that earn $1,800 each. And so our total gross pay is $3,600. And so that's going to be a debit. It's an expense, so it has to be a debit. And the next thing we're going to see is all of those things that get held out of the paycheck. So again, thinking about your paycheck stub, you see your gross pay, and then sadly you see all those taxes that are withheld. So it looks like we have federal income tax, and we have state, I think that was the next one, state income tax. And FICA tax, and federal and state unemployment. All right, so here's the tricky part. Federal income tax and state income tax is paid by the employee. So those amounts are taken out of the employee's paycheck. FICA tax is paid by the employee, and it's also shared by the employer, so we'll talk about that a little bit more in a minute. Federal and state unemployment tax are not paid by the employee. You do not keep those out of the employee's paychecks. So we're just going to set that aside for now because that's not an amount that comes out of the employee's check because they're not responsible for that tax. All right, so we've got a debit. We need to record our withholdings. Those are all payables because we actually owe those to some taxing authority. So federal income tax withholding and FICA tax goes to the federal government, and then state income tax withholding goes to the state government. So we're basically acting as a conduit for those taxes. So we're keeping those taxes out of the employee's check, but it's really their money that we're withholding, and then we're going to just turn around and pay those taxes into the taxing authority. So it's never really our money. We're just collecting it for the government. So because we're collecting it for the government, the moment that we withhold it, it becomes a liability to the government. That's why these are payables. So we're going to calculate our tax. So it says tax rate is 11% for federal income tax. So I'm going to take the $3,600 times 11%. It's $396. State was 6%, so I'm going to take the $3,600 times 6% is $216. And FICA was 7.65%, and that's Social Security and Medicare lumped together. So $3,600 times 7.65%. It's $275.40, and I'm not going to put the pennies there, so we're just going to round it. So, and yours should actually, I think, come out even. So $275 for that. And then you'll notice we've got a problem because our debit is $3,600. We've got 3 credits, but that's nowhere close to $3,600, so we're out of balance. So again, think back to your paycheck stub. You have gross pay, all the stuff they kept out, and what's left is your net pay. So your net pay is going to be, or their net pay is going to be the gross pay, which is $3,600, minus these things that we withheld. So minus $396, minus $216, minus $275 gives us what's left, which is our net pay of $27.13. So I'm just going to add those up again and make sure I didn't have any math errors. All right, so now we're in balance. We've got debits equals total credits. That net pay is money that you owe your employees. So those are salaries payable or wages payable, some kind of payroll tax or payroll payable, something like that. So that's the first entry you're going to do. So that records your payroll tax expense or your not your payroll tax expense, your salaries expense or your salaries and wages expense or your payroll expense. Just depends on what you want to call it. But that's the cost of you for paying those employees for their work. The second entry is actually going to be on 1127 also. And this is the one that we're going to record our expenses for taxes. So some taxes the employees paid, which is these. We also, as an employer, are responsible for paying some payroll taxes. So an expense goes first. It's going to be a debit. And those expenses, I already told you, we're going to pay the unemployment tax. The other one that's kind of tricky is that we're going to pay FICA tax. And the reason is that Social Security and Medicare tax, which are the taxes that make up FICA, those are shared taxes. So the tax that the employee pays is matched dollar for dollar by the employer, and it's dollar for dollar at the moment. That could change, but it generally is dollar for dollar. So when we're going to record our payroll tax expense, we're going to have to calculate the unemployment tax. And unemployment tax is on the first $7,000 that each employee makes. Well, this is the first pay period, so they've only each made $1,800, so they're not close to the $7,000. So all of their pay is subject to unemployment. So their total pay was $3,600. We're going to multiply that by the unemployment rate, which was 5.2%. And that's our unemployment tax payable. I got $187.20. I'm just going to round that to $187. And then FICA tax. FICA tax is matched by the employer. So you can go back and take the one of the $3,600, which is the total payroll, times the 7.65%. But just kind of a hint, it should be the same as the employee's part because it's matched dollar for dollar. So it should be $275. Those are the taxes that the employer is responsible for paying. So those are our credits. We're going to add those together, and the total of those two is actually the payroll taxes that the employer is funding. So that's their payroll tax expense. All right, so that gets your two entries for the date of payroll. And then I believe on the 30th, you're actually going to pay your employees. So when you get ready to pay your employees, it's just pretty simple. We owe the employees right here. There's their salaries payable. That's what we owe. So this is the entry that we write when we actually cut the checks and give them to the employees. So when we cut those checks, we do not owe them salaries anymore. So that salaries payable, we credit it here. We're going to debit it to take it off the books. And generally, employees like to be paid in money, so we're going to credit cash. And when I say cash, that's cash in the bank. That includes that. So paychecks would include that. So debits and credits in balance. That's all there is to it. Now, in real life, we would actually go back and write checks to the federal government, the state government, and then federal and state for unemployment tax. This problem doesn't ask you to actually pay those income taxes. So we just record the tax and we're just going to leave them in that tax payable accounts. So that's all there is to it. I hope this helps. If you get stuck on anything, always feel free to contact me.